As deficits continue to grow, the bond market feels the stress of that as we have to issue more debt, interest rates go up, and there's no way out. I mean, these people, the people who run the Fed are completely, totally, and utterly fucked. They are going to lose this battle, and the currency is going to ultimately become worthless. And you're seeing them start to indicate that they're going to have to pivot. And I think in terms of an event horizon, we're all of the belief that that pivot has got to come fairly soon.
So that pivot would indicate resumed QE. I like to say QE infinity is inevitable.
On September 18, 2023, the United States national debt hit $33 trillion for the first time in history. By comparison, just 4 decades ago, the national debt was hovering around $907 billion, meaning it took over 200 years to pile up the first $1 trillion in debt and just around 40 years to pile in the next $32 trillion. And that's not even the craziest part. In less than a month since the national debt hit $33 trillion, we've piled on another $527 billion, which is over 66% of the $796 billion annual defense budget. Maya McInnes, the president of the Committee for a Responsible Federal Budget, correctly captures the absurdity and perilousness of the situation in a statement which reads, "The United States has hit a new milestone that no one will be proud of. Our gross national debt just surpassed $33 trillion. Debt held by the public, meanwhile, recently surpassed $26 trillion. We are becoming numb to the huge numbers, but it doesn't make them any less dangerous. A majority of the American population might be numb to these numbers or even unaware of the grave consequences that lie ahead for the financial system, but not sound money advocates like Greg Foss, a Validus Power executive, James Lavish, a reformed hedge fund manager, Lawrence Lepard, a managing partner at equity fund management, and Preston Pysh, co-founder of the Investors Podcast Network. These men, who have been participants in the traditional financial industry for years, if not decades, believe the United States debt burden has grown too large, and the country is right on the verge of a huge credit event that would overturn the economy and severely damage the existing financial system. According to Foss and Lepard, the only way out is for the government to keep printing, and the more they print, the deeper we sink into the debt spiral until everything completely blows off in our faces. As we bring you clips from a recent and quite illuminating fireside chat between these gentlemen, please ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Everything helps with the YouTube algorithm and contributes to the channel's growth. Thanks and enjoy.
Basically, the debt spiral, if you were looking at the United States Treasury and you considered it, if you were looking at it like a company on the New York Stock Exchange, we would call it a zombie company. Now, what do I mean by that? Well, it means that the company isn't covering its interest expense with its earnings, okay? So if you look at the United States Treasury, and we look at all of their expenses, you have mandatory expenses like the Social Security, Medicare, Medicaid, and then those are signed into legislation. They have no choice. They've got to pay these expenses, right? Then you've got big expenses that are signed into long-term contracts like the defense spending. When you add those up and you add interest expenses on the debt, they total more than the United States Treasury takes in earnings, which is really just tax dollars, every year. So that creates a deficit. And in the United States, we've been operating in a perpetual deficit for a very long time. And so that deficit leads to us having to borrow more to cover the deficit, which is issuing bonds. And then you have to pay interest on those bonds, and then you have to, that interest that you're paying now creates a larger deficit. And as that deficit grows, it creates a larger interest expense, which creates what? A larger deficit. And eventually it creates the demand for treasuries to fall, which means that you're going to have to pay more interest on that. And as interest rates are rising, you're paying even more interest on the debt that you're issuing, which creates what? A larger deficit. And this is called the
Debt spiral. So eloquently put, James, people would argue, well, don't worry. The economy is growing just as fast as the debt is. That's false. total debt to GDP is a very important metric because total debt gets paid by tax revenue on GDP, right? So you have a numerator, total debt, you have your denominator, GDP. The fact of the matter is that your total debt is growing faster than your sales growth or GDP. Larry.
Yeah, so in 2008, when John Law was running the Federal Reserve, Ben Bernanke was running the Federal Reserve, things changed. And the U.S. national debt since that date has grown at a rate of 8.5%, and the GDP has grown at a rate of 4%. That's the fundamental problem. The GDP is necessary to pay the interest on the debt. And so the Keynesian experiment, as we know it, it's toast. It's all over. These guys have been lying. We know it. They know it. They know we know. And we're about to put them in their grave.
So if you want to put a number on it, I'm going to turn it over to Preston here, but if you want to put a number on it, that the United States added $500 billion of debt in the last 2 weeks. So now we have borrowed $33.5 trillion. So we just crossed $33 trillion, and we just added another 500 to it in 2 weeks.
I just want to put context on that number. So we hear these numbers, 500 billion in the last 2 weeks. And for most people, they're just like, oh, that sounds like that's a really big number. If you look at the Department of Defense, they spend, what, 700, 800 billion in a year, okay? We have added 500 billion, almost that same amount in the last 2 weeks. So to really like wrap your head around these numbers, think about the meme when people post on Twitter of like the aircraft carrier going through the sea with the fighter jets and all the training and all the personnel and all the bases. You go to Texas, there's a road at Fort Hood. It's 7-8 miles long with tanks for 7 or 8 miles. To fund all of that, the people, the material, the R&D, all of it, $700 billion. We've added $500 billion in the last 2 weeks.
Hardly anyone is really paying attention to how quickly the United States and the entire global debt-based monetary system is sinking under the weight of the recklessness, stupidity, and greed of policymakers. But those paying attention are pointing out some very hard facts that are getting more and more difficult to ignore. Sven Henrich, a financial market strategist, really puts things into perspective in a recent post on X. The post reads, "It took the top 0.1% 17 years to gain $6 trillion between 1990 and 2007. It took them 11 years to gain $6 trillion following the great financial crisis, and then it took only 2 years for the top 0.1% to gain $6 trillion after the pandemic. All the while, the middle class kept shrinking. That's the true legacy of Fed policy, the biggest driver of wealth inequality, as Stan Druckenmiller has stated. So if we really consider it, all of this insane wealth creation is only for the wealthy. For the ordinary American, the dizzying rate of currency debasement is nothing but complete utter destruction, and in subsequent years is going to escalate at a much faster rate. As Lavish and Preston note during the fireside chat, the interest expense was about $600 billion in 2022. This year, it's just a little under $1 trillion. By 2026, if interest rates remain as high, it will be over $2 trillion. Let's get back to the fireside chat.
Fundamentally, what we have here is a sovereign debt crisis, and the United States is starting to look like a third world country. You know, we've seen this pattern before. This is not new. We've never seen it in the world's reserve currency, which is what we have here, but we've seen it in Argentina, we've seen it in Venezuela, we've seen it in Zimbabwe, we've seen it in Weimar, time and time again. And the fact of the matter is that as deficits continue to grow, the bond market feels the stress of that as we have to issue more debt, interest rates go up, and there's no way out. I mean, these people, the people who run the Fed, are completely, totally, and utterly fucked. They are going to lose this battle, and the currency is going to ultimately become worthless. And you can kind of see that. I mean, in Powell's most recent presser, he said he's navigated under cloudy skies with a sextant. I mean, dude, we got GPS. I mean, what the fuck? You know, I mean, the guy has no clue what he's doing, and you're seeing him start to indicate that they're going to have to pivot. And I think in terms of an event horizon, we're all of the belief that that pivot has got to come fairly soon.
So that pivot would indicate resumed QE. I like to say QE infinity is inevitable. But with resumed QE, what you have is accelerated fiat debasement.
Something that's really important to understand is we keep talking about QE and how the Fed's going to pivot, they're going to provide liquidity to the market. This is all, the reason why they must do that is exactly what we're talking about. The Treasury must have a market that will buy Treasuries. It must stay liquid. It absolutely has to have a place to dump all these Treasuries. And you're seeing the rates of the Treasuries rise on the long end, looking for price discovery on where these rates are going to go, because they know that the Fed or the Treasury has to have a market for them. It cannot break. So when we talk about QE, quantitative easing, what we're talking about in simple terms is the Treasury pushing a button, putting a bunch of money on the Fed's balance sheet. The Fed tells Citigroup and JP Morgan to go buy a bunch of bonds in the market. We're going to buy them back from you today. The Fed gives them the money and then turns around and holds the Treasuries on its balance sheet, right? So that's QE. They're literally monetizing the debt. And we've seen this happen in Japan, where Japan owns, the Bank of Japan is the largest owner of its own debt. Think through that for a second. They own more than 50% of its own debt. So that's where we're headed as a country.
And as Greg says, it's just math. And historically, we've seen this many, many times. We saw it in 2008. We saw it in the repo crisis in 2018. We saw it in March of this year. I mean, the Fed actually arguably already has pivoted. BTFP was a small pivot. And so we know that their third mandate, their two mandates are obviously full employment and inflation. They failed at inflation, obviously. We know their third mandate is keeping the system functioning. And every time it doesn't function, they do the exact same thing, which is they pivot. And I want to just read 3 headlines. These are just from yesterday. Nick Tamaros in the Journal. If the bond market keeps this up, the Federal Reserve will have less of a reason to hike rates again. Wonder what that means. Wall Street Journal headline yesterday. Rising interest rates mean deficits finally matter. Bond sell-off might force the Fed to rethink shedding assets. What does that mean? Okay. Breaking markets. Fed's daily. With the rise in bond yields, the need to do additional tightening by the Fed is not there. What does that mean? These fuckers are going to print. They're going to print until their fucking eyes bleed. And we know it's going to happen. And so all we've got to do is outlast them and then watch them as they suffer.
According to recent estimates, tax receipts are down by about 10% this year. More and more economists are warning that the economy is heading for a recession. And by the end of the third quarter in September, 516 companies had filed for bankruptcy. To put that in perspective, 518 bankruptcy filings were recorded through the end of the third quarter in 2020, meaning the pace of filings this year has been about the same. If it continues at the same pace this quarter, 2023 could easily surpass 2020 as the worst year for corporate bankruptcies in more than a decade. This is why Foss and the rest of the panelists are certain that the United States is heading for a huge credit event within the next 12 months, which would necessitate more printing by the Fed and further aggravate the underlying causes of the crisis. So we would essentially be going from one crisis to the other, each bigger than the preceding one, with little periods of deceptive relief in between. According to the panelists, only people who prepare ahead by investing in hard assets like Bitcoin will be able to muddle through with barely a scratch. Foss says to do the math, fiat debasement is 100% certain. Bitcoin is insurance against that outcome, which means there's a very good chance that it survives and thrives through whatever is coming. What are your thoughts on the illuminating fireside chat and the gloomy but accurate outlook on the economy of the United States? Please drop your comments and observations below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.